And here we are on a 2-minute chart for the pound yen in the spot forex market. And we've got two examples on the chart for the dynamic volatility indicator. The first over to the left and the second over to the right. If we take the one on the left first, you can see there the indicator has triggered. The market has fallen quite sharply with a red down candle, and the volatility indicator has triggered with the little purple arrow to the top and bottom of the candle, telling us instantly that that particular piece of price action, that candle, has moved outside the average true range. Now what's happened subsequently is that the price action has reverted back inside the spread of the candle, and this is why it's so powerful. This is very typical of what happens when the volatility indicator is triggered, and the reason for this is very simple. The indicator and volatility are generally associated with market news, with economic data, with statements, press releases, and as a result we see a volatile price action enter the market. And this is the point at which the market makers, the insiders, the big operators, call them what you will, are there to trap you on the wrong side of the market. What's happened here is that the market has fallen sharply on that candle. Traders have jumped in, not wishing to miss out on some easy opportunities to the downside, and the market has instantly reversed back inside the spread of the candle. And that's why it's such a powerful indicator. It's very simple, but it's immensely powerful. It's a warning signal that volatility has entered the market on that candle. And as I say, there are lots of different reasons for it coming into the market, but generally speaking, it's economic news data and statements. And the market makers and the big operators will use it to trap you on the wrong side of the market into a weak position. Because as traders, we all want to jump into some easy profits. If the market's falling or rising quickly, we want to be on board that train. And what happens is the market instantly reverses and moves back inside the spread of the wide candle, which has been triggered with the volatility indicator. We've got a second example over to the right. Once again, we had a widespread down candle. The market was preceded, or that particular candle was preceded with a long-legged doji, so some indecision coming in at that point. The next candle is a widespread down candle with the volatility indicator triggered. What happens? There's no follow through. Traders will have been trapped once again, jumping in, looking to short, and the market promptly reverses and goes in completely the opposite direction, pulls back inside the spread of the candle, trapping those short traders in weak positions. It happens all the time. If you're not in the market, if you don't have a position in the market, it's a warning signal to stay out and be patient and wait for confirmation of that particular volatility candle to be confirmed with follow through. In other words, for a close well above or below, depending on which direction the market is traveling in. So if you're not in the market, it's a stay out signal. It's a wait and see what is going to happen. And these two examples here are very, very typical of what occurs once the indicator has been triggered, because when all's said and done, it is a trap move to trap you into a weak position. And that's why the market reverses back inside the body of the candle. So let's take a look at another chart where we can see confirmation of the indicator in action. And here we are, we've stayed within the spot forex market. We're on a slightly slower time frame chart, a 30-minute this time, and we're on the Euro-Aussie dollar pair. And we've got some nice examples of the volatility indicator here in action, both confirming and also warning to stay out. Over on the left, we've got an example of the trap move that I talked about earlier. Here we saw the market spike and the subsequent price action then reverse back into the spread of the candle. So there was no follow through, this time to the upside. Later in the session, we then had a volatility candle, a very widespread volatility candle, the market surging higher. And on this occasion, it was duly confirmed with a further candle, in fact, a further volatility candle to the upside. So really, if you like, on this occasion, volatility confirming volatility. Now, the second candle could have had the volatility indicator triggered, or it could simply have been a candle that was not particularly volatile, but merely confirmed the price action. In other words, the price action of the second candle closed well above the volatility candle itself. And this is what I meant by confirmation of the volatility. If you have a volatility indicator triggered, as we have on the first candle, and then the price action duly moves away from it and closes well above, in this case, or it could have been below if we were moving to the downside, then that's confirming that this is a genuine move. In other words, it's not a trap move, because the big operators, the insiders and market makers, are joining in the move. It's not a trap move like the first example to the left. And indeed, we have a further volatility candle which is triggered after the small reversal, confirming once again. Now, after that, the price action did revert back inside the spread, but duly continued higher up in the trend, confirming the initial confirmation on the second candle immediately following the first. And that's what the volatility indicator is all about. If you're in the market and one of these is triggered, then you have a decision to make. You've got to decide whether to stay in or to close out, depending on whether you're in profit or loss, or make a decision according to your other indicators. But this is a heads-up warning. If you're not in the market, it's a warning to stay out. Wait for the consequent price action. If it confirms the indicator, that's great. You can consider taking a position. If not, then you need to consider staying out and waiting and being patient. So I hope you've enjoyed watching this video on the dynamic volatility indicator. It's a very simple indicator, but immensely powerful. Volatility is both good and bad, and this will help to describe volatility on the screen on your chart for you and help you to assess the times to trade and the time to stay out of the market and wait and be patient. So why not add the volatility indicator to your trading toolkit for NinjaTrader? Thanks for watching, and see you again soon, and bye for now.